Okay, welcome everybody to our special Friday webinar, Surviving and Thriving in a Bear Market using SVA, that is Structural Valuation Analysis. My name is Gilbert Ananajer. I'll be moderating this webinar. If you do have any questions, please feel free to type it in the chat on the bottom right of your screen. But without further ado, the man you came here to see, Ross Healy, take it away.
Okay, thank you, Gilbert. For the next 30 minutes, we are going to examine how you can survive and even thrive in a bear market. All of you are veterans of Fang Friday, so I think you have a reasonable idea of how our SVA system functions, but we are going to expand that understanding to the entire market. So let's get going, and let's open with the musical question. What is a bear market? Actually, what is a bear market not? Well, I started off and I asked my wife, what's a bear market? And she said, I know what that is. That's when stocks go down. And one might have expanded that to a little more technical background, because people say, well, it's when there is a 20% plus decline in the overall market. Well, these are very lazy ways of defining what a bear market is, and they don't help investors to cope with the event. So that, of course, is what we are going to do today. So what is a bear market? Well, it's a period of time during which there is a general revision, a rethinking of share price valuations. A shift to discipline and rigor characterizes the valuation process going forward, away from speculation and hope and towards strong current values. The market itself is revalued, but not all stocks necessarily. This does not mean that there's going to be a synchronized decline. Okay, that is to say, not everything is going to go down. And in fact, what we're going to find out is some values are actually going to rise. Although I will have to admit that every bear market that I have certainly experienced has tended to end with a period when nearly all shares were revalued downwards simultaneously right at the end. Now, can one forecast a bear market? That is to say, with precise timing in advance? In a word, the answer is no. Now, I can identify extreme valuations. I can identify weak and risky valuations. And I can make a loud public noise. And many bears, both now and leading up to past bear markets, have done that. They have publicly said, we are going to have a bear market. It's going to be this, it's going to be that, and so on. And what they have done is that they have either scared people out too early, and therefore the market kept on going, leaving lots of gains on the table, or they were simply ignored. I mean, I can remember going into 1999-2000, the last 6 months going into that market. A number, actually, of money managers and a number of forecasters could see very clearly that something nasty was in the cards, and they got their clients out. Well, between about September, October of 1999 and March to June of 2000, there was one heck of a rise in the market, particularly the NASDAQ stocks, the high-tech stocks. And what happened is that they got many people out early, and they said, do you know how much money I lost? I didn't course. But do you know how much money I lost because you got me out early? And they got annoyed and left. So you want something better than just a kind of a general observation. Yeah, that the market is expensive and risky, because it can be that way for quite a while. However, I can identify when the odds start to tip in favor of a shift to a bear market. But I will have to admit that I, for one, cannot forecast in advance exactly when a bear market will begin. Now, can SVA time a bear market? Well, our records show that using SVA, we have timed the exact beginning and the end of 5 of the last 6 bear markets. And we're going to take a look at that in a moment and where they happened. And we're in one now. Okay, so here is a picture of the NASDAQ 100, and look what happened. Okay, look. Let's go back all the way down to the to the bottom of that COVID setback down here. We had a run up. The NASDAQ went up to the bubble price, which, by the way, is 7.4 times book value. You may remember. Broke out, pulled back with beautiful precision, and then soldiered on right up to its next breakpoint, which is the HB1 price. That's 9.5 times book value. Now, interestingly, okay, the market hit there and went up once, twice, 3 times before it decided to fall away. And I've seen this before back in the year 2000. Well, the NASDAQ fell right back down to its bubble price, and that is a very, very powerful valuation level from a mathematical point of view. Had a beautiful bounce, but retraced and now has broken down. And of course, you know what's happened. Okay, the market has broken down, but then it had a nice rally almost back to the bubble price. And we've seen this happen many times before, haven't we, looking at the fangs? Okay, we get a breakdown and a pullback, and then we go. Now, before we leave this chart, what's wrong with this picture? Well, look at the fair market value of the NASDAQ. Well, what happened in the COVID meltdown, the market actually, the NASDAQ actually got back to its fair market value. But at the peak, look at that spectacular distance. Okay, that was 50%. Okay, more than the fair market value. That is an awful long way to fall. Well, we're on our way, but we're not there yet. And what I have to tell you is that not only do markets at their bottoms, unlike the last time, not only do they tend to fall to their fair market value, but of course, at the fair market value, you're not buying any value, are you? Okay, what you really want to do is you want to get something that is a discount to the fair market value. And when we're choosing stocks, of course, that's what we do. We always choose stocks that are at a good discount to their fair market value. So that's what's wrong with this picture. Anybody who thinks, oh, well, we've already had quite a setback in this market, I think that values are really building. Maybe we should be thinking of getting back in there. I think I would think again, the market, at least the NASDAQ anyway, is nowhere near good value. Now, here's our breakdown and our pullback. Is there any confirmation of the fact that this market wants to go lower? Well, let's go and take a look at the Standard & Poor's 500. Now, here at the bottom of that COVID meltdown, look at that. We actually got quite a discount to the fair market value. So there was a good reason for that market to bounce back very, very strongly. Although, when you see the values here for the Standard & Poor's, they certainly did not keep up with the index itself. Now, In 2000, the Standard & Poor's got up to its low super growth price here, which is 4.5 times book value. And back then, it actually hit once, twice, 3 times, and then went. Well, this time it didn't do it. However, we didn't have to worry about that because it was the NASDAQ that did it instead. Now, so far, unlike the NASDAQ, which is still far away from its fair market value, the S&P has at least pulled back to its fair market value. Doesn't make it cheap, however. It is essential, by the way, that when we get a bear market, that we get the standard in the United States, that we get the Standard & Poor's 500 confirmed by the NASDAQ, or the NASDAQ confirmed by the Standard & Poor's 500. If you don't get that, we don't have a bear market. Now, I will have to admit that the last few days, just not the last couple of days, but the last few days before that, when the Standard & Poor's rallied right back up to this is its super growth price, by the way, 3.5 times book value. And it got, by the way, it got there with dead precision, okay? Gilbert and I looked at that and we kind of wondered, you know, we've never had a confirmed breakdown which got rescinded. In other words, the market said, oops, I think we made a mistake in this bear market call, so let's get back over the line and continue on upwards. I had never seen one before. However, you know, these times are different. The Fed is there with all their money and everything else. Who knows? Maybe they could pull a reverse off. Well, what happened, of course, was that we had those nasty inflation numbers confirming, therefore, that we're not only going to get another 50 basis points, but anybody who thinks that the Fed is going to sort of ooze off and ease away from their language, given the powerful inflationary numbers, it's probably going to be anything but that. And the market appears very much to be continuing on its way down. Now, let's go and take a look at the Standard & Poor's S&P composite index, because we get an entirely different picture. Yes, here starting into the COVID pandemic, we actually started at its high conservation price, 1.5 times book value, went into a steep slide and pulled back, but has been moving up steadily. But what's really interesting here is that look at that beautiful swing in the fair market value. It's gone up and up and up. And indeed, the gap here is now some 50%. So in terms of seeking value in a bear market, the Standard & Poor's composite has been one place to look. One of the things that we offer our clients is a model portfolio. And going into this year, we could see the tremendous advantage of the TSX over the American indices. We could see that there was a lot of value there. So that's where we put our model. And to date, by the way, against a TSX composite, which is off 2 or 3%, our model is up 16%. And of course, against the American market, it's been a major win. This isn't the first time that we've been able to do this. Back in 2000, we actually at that time, we don't do it anymore, but we actually at that time we ran 2 models, a TSX model, which we're still doing, but we also ran a Dow 30 model, and we got rid of all of the high technology stocks, all of the overvalued stocks. And between 2000 and 2002, that portfolio actually, and over a 3-year period, actually beat the Standard & Poor's 500 by a compound 28%. That was the degree to which those excessively priced stocks had to come down. So can you make money? Can you thrive and make money in a bear market? Sure you can. Just remember what a bear market is. It's a sorting process. It's not a collapsing process. It's a sorting process. Well, I've actually answered the question, what's intriguing? It's that beautiful, beautiful fair market value run. Now, why does a share price fall? Well, in simple terms, a price decline is a result of a revision. It's a rethinking of the valuation of a given company. And it comes as a response to changing business and economic conditions in which the share price valuation, that is, say, the price, is believed to be out of line with new expectations, and therefore they have to pull in line. A price decline is a company-specific event. However, I will have to note that the market also has a memory, and some stocks can be very market sensitive, and I'm going to show you a particularly intriguing one right now. Okay, this is called A Market Remembers, and here's an interesting stock, isn't it? I'll tell you what it is in a moment. But look at this stock. Okay, back in 98, 2000, the stock came right up to its mid-growth price. That's 2.5 times book value. In the bear market that followed, it went down to its previous low. Okay, its low mid price, which is a 20% discount to book. In the subsequent bull market to 2008, the stock went right back up again to its mid-growth price, fell again to its low mid price, and just before the COVID pandemic, sure enough, the stock had risen right back to its mid-growth price. And bearing in mind what we'd seen before, we put a sellout on the stock. Well, what happened? That's exactly what happened. In the COVID recovery, it moved all the way back again to its mid-growth price. The only thing that we could possibly do here was put a sellout on the stock once again. I mean, wouldn't it be nice if every stock were this regular? Well, quite frankly, many SVA charts are, by far from all of them. Let me tell you that. Otherwise, investing in this market would be dead simple, but many are. This, if you are curious to know what this is Canadian Tire. It is a remarkable reflection or almost forecast of what the stock market is about to bring us. And it has rendered a sell signal. Well, how does this, that is my stock discussion, differ from a bear market? Well, a bear market is a revision. It's a rethinking of share prices in the aggregate, and comes, like shares, as a response to changing business and economic conditions. Bear markets come when valuations are extreme, and again, in the aggregate. But a bear market is also a sorting event, meaning that price declines are not synchronous, and a bear market gives you lots of opportunity along the way to make money. Now, are there any markers for an incipient bear market? Well, the markers for a bear market are the same as an individual stock. The price of the overall market is a function of its forward earnings, its fair market value. and the market's valuation may rise to a key boundary condition, which it then fails to exceed. It did that in 1987, 1998, 2000, and very recently in 2000, late 2001, early 2002 for the NASDAQ only. Or, so it can rise to and then fail, or it can fall to a key boundary condition and then break down. Well, we saw that in 2008. And of course, as I just showed you, okay, we can see that right today in 2022 when both of the US indices have broken down. Are bear markets regular? Well, if they were, wouldn't be for long, as the market, which is ever forward-looking, would anticipate it and would act in advance. So every bear market is different than the last one, and each has its own beginning. However, every bear market that we've ever encountered so far has had a definite starting point. They just don't sort of come out of the blue, save one. So where have markets peaked? Well, let's go and take a look at the last 6 bears. 1987, the Standard & Poor's peaked out right at its growth price. That's 2 times adjusted book value, or I'm just putting BV for short here, twice book value. In 1998, the Standard & Poor's peaked at its super growth price. That's 3.5 times book value. There was a broad revaluation of the entire market between 1987 and 1998, and everything went up. But we were actually looking for a peak at the super growth price. And of course, that was aided and abetted by problems in Russia with Russian debt, and then the collapse of that hedge fund long-term capital management run by a bunch of Nobel economic winners who clearly didn't know much about the market. In 2000, as I said, the Standard & Poor's triple topped at its LSG price. That's 4.5 times book. So bang, 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 and then crunch. And in 2008, this was a really interesting marketing. The slope of those lines of mine, that is to say, which is the slope of the book value, was running between 2002 and 2008 at about a 12% rate, and the Standard & Poor's came down, actually broke below early in 2008, but recovered because it wasn't confirmed. Moved along, broke down again, recovered. It wasn't until September the 1st of 2008 that not only did the NASDAQ, at least the Standard & Poor's broke down, but then the NASDAQ, which had been sitting on its super growth price all the way during that period, finally decided to break too. And when it did, we had a perfect confirmation of a bear market. 2020, nothing you can say about there. It was an exogenous, it was a surprise. There was no breakpoint, there was no indication. You saw actually that the TSX actually, in a sense, kind of peaked at its high conservation price of 1.5 times book value. But I generally speaking, when I'm looking at the overall market, I really have to have the U.S. market included in order for me to call any kind of a serious bear market. However, in late 2001, 2002, the NASDAQ triple topped at its HB1 price. That's 9.5 times book. So it went up. We didn't know it was going to break out, by the way, or not. Came back, up again, came back, up again, and then keeled over. Okay, so it was the keel over that we knew that we were in trouble, even though at that time the Standard & Poor's had not confirmed that we were in any kind of a bear market. However, in 2022, the Standard & Poor's did break its super growth price, 3.5 times book. And the NASDAQ broke its bubble price at 7.4 times book value. Those are two powerful mathematical values in the mathematics that underlies our work. And when that happened, we were very, very sure that it wasn't coming back, even though we got a little bit nervous just at the end. Well, where have bear markets ended? Well, we've got 6 bears and 5 different endings so far, because of course we don't know what's going to happen with this one, but they always end at key market breakpoints. Always. 1987, remember that I told you the market peaked at its growth price. It set back to its high conservation price. That's 1.5 times book value. That, by the way, is a decline of 38%. Okay, well, 38% certainly classifies as definitely as a bear market. And with that decline of 38%, bang, things turned around and headed back up again. In 1998, the market bottomed. Remember, it started at its super growth price. It bottomed at its growth price. That's 2 times book value. That's after all of the terror of long-term capital management, which, by the way, nearly destroyed 3 major U.S. banks. In 2000 and 2002, the market came down, and in July of 2002, the market came right down to its growth price, a perfect hit. In 2008, in that setback from its growth price, it set back at its normal price, at its book value. And that, by the way, of course, 2 times book value to 1 times book value, that's a 50% drop, which it did in all of 2 months. That was a bear market to conjure with, because it was almost impossible to find defensive value in that particular market. In 2020, the COVID meltdown actually carried the market down towards two times book value, the market, and we have an interesting conversation there that happened about 1 week before the market bottomed, and I'm going to turn things over to Gilbert to tell you all what happened at that time. So, Gilbert?
So, where do we see the bottom? Well, in 2002, on July 26, 2002. I'll remember that day for a very, very long time, because I was on the BNN with Jim O'Connell, and he asked me, I was been bearish for a long time, and he said, well, Ross, what do you think about the market? And I said, the market bottomed this morning, and it had, because it bottomed at twice book. Well, twice book, okay, for the S&P is 2175.
Wow.
So that's another 200 points from here.
Yes, sir.
Anita, that's 1 day trading. Just look at what happened today.
Yeah. Well, that was very interesting. By the way, the market did the futures bottomed at 2173. I think the actual market itself had closed a little bit higher than that, but the futures closed almost perfectly right at its growth price. And the rally, of course, was history. So keep all of these very much in mind, because we're now in a bear market, and the question is, where is it going to bottom? Well, we have to say TBA. But at least we have some ideas when we look at history, We know that the market is not going to bottom just out of thin air. It's going to get someplace, and it's probably, if history is any indication, it's probably going to be a significant breakpoint. We actually, historically, have found that that the lows in the market have tended to be pretty obvious. So you want to kind of hang on and wait and see, because at some point there's going to be a terrific buying opportunity, but it certainly is not going to be for a little while. Now, there is a cycle of emotion which gets associated with bull markets and bear markets. And our question, of course, is where are we right now in that cycle? Well, we are certainly not in this part of the cycle, are we? Okay. In fact, we have rolled over and we're heading down into this part of the cycle. Where exactly we are, we're not sure. I suspect that we are somewhere between denial and concern. I still see a lot of commentators saying, you know, this market has now pulled back nicely, and you've seen how far down the NASDAQ has fallen, and it's fallen a long way. It's nowhere near value, but it's fallen a long way. So what are people looking for? This is that, you know, they still remember the good old days, eh? They still remember these days here. Okay, so we're not down here. Okay, we're somewhere in here. We're thinking, you know, that's about it. That's all we really need to do, or should we? Okay, and all of which tells me that we have miles to go before we sleep. Now, I call this next slide hitting for the cycle. And obviously, you recognize that I'm a baseball fan. I'm a big Blue Jays fan. And so I got thinking about, like, what happens in that in this fall from anxiety, denial, concern, fear, panic. What happens in that cycle? Well, let's go and take a look. The first stocks that start to fall are the ones with no value at all. And Peloton was an absolutely perfect example of that. And Gilbert is going to show you what Peloton looked like.
Yeah, Ross, so I've got Peloton up on the screen.
Okay, good. All right.
As you're going along, so feel
free. Okay, good. Okay, take a good look at Peloton. Okay, it was way up there, way up in the high bubble levels. Do you see any fair market value? No, none. By the way, the stock has fallen a long way. Do you see any fair market value now? Do you think that Peloton is finished? Well, God bless if you do, but I have to say that this stock is probably going to fall at least to its book value. And the problem with that is that the book value is disappearing, as you can see by the fact that the lines on the chart are fading away. Those tell us that the book value of the company are disappearing. So if I tell you that this is going to bottom at its book value, you can say, well, Ross, where's the book value? And I have to say, I haven't a clue, but it certainly isn't anywhere near where the stock is today. Then we get the very overvalued stocks, okay? And Starbucks is a lovely example. I mean, this is a great company, okay? But look how high it got relative to its book value. This was a catastrophe waiting to happen to the investors who happened to own it. They kept thinking, well, the growth is going to go on and on and on and on and on and on forever. Well, you could already see where the growth is, because that was the slope of the fair market value. There was a long way to go, and indeed, Starbucks is heading down there. But keep in mind that when it gets there, that doesn't mean that you ought to rush out and buy it. Although what I notice with many companies when they hit their fair market values, they do give us a pop. So there may be a little trading opportunity. I'm not going to say there isn't. But before, Starbucks will be a good kind of stock that you want to put into your portfolio and leave it for the next 5 or 10 years. You're going to want a nice discount from its intrinsic value. Then we have just what I would call the overvalued value stocks, and Adobe is one of them. I mean, everybody has Adobe on the computer, don't they? So, you know, everybody uses Adobe, everybody has Adobe. There it is. And the stock just kept on going and going and going and going. Well, when we get into a bear market and we got into a revaluation cycle, bang, Adobe is pulling back down towards its fair market value. And again, if I were to show you the very long-term view of Adobe, that you would see that in times past, when the stock has bottomed, it's bottomed at a nice discount to its fair market value. Then there are the fully valued stocks. Start off reasonably fully valued, like Disney. And what Disney has done, of course, is it's pulled right back now to its fair market value. But look at that chart. It's hit its growth price and it's sliding underneath it. Okay, when I see stocks like that, I normally expect that we're going to get, okay, a further move down. So Disney is not a deal at the present time. Then we get some stocks that actually started out a little bit undervalued, but these are the ones where the economic and the business fundamentals have been fundamentally working against them. And Ford is a very clear example of that, and it has had a move basically from its growth price to its book value, as has GM and quite a number of stocks. Well, when we get through all of those stocks and the undervalued stocks, eventually in the end, it's going to be a case of practically everything or everything. In other words, a full panic mode. And we can wait for that. But I think you will be able to see that when it actually comes. Now, in all of this, how do we make any money? Well, in SVA terms, okay, expectations are running in the opposite direction to a bull market. In a bull market, the expectations are the values go up. In a bear market, the expectations are that the values go down. In other words, we look for stocks that are breaking support to the downs, like Disney. Okay? That looks like a stock very much to me, which has a nice downside future for it from here. We also watch for stocks that still have poor fair market potential, okay, as they are quite vulnerable. And there's a lot of NASDAQ stocks in particular that have poor market value. And of course, all of you from Fang Friday know that, there are two stocks actually, a Meta and our friend that's in the streaming business have had big declines from price, but most of the stocks are still pretty expensive. So we have to watch that group in particular. But you should also be looking for value stocks to buy, and that is to say that in a catastrophe, everything is not a catastrophe. There are usually good opportunities to purchase. And as I said about our current model, we have a number of those stocks going back into 2000. Those value stocks actually came through beautifully and beat the market solidly. So there are opportunities there as well as risks. one might well consider some cash holdings. And the reason that I would say that, rather than saying, well, sell all the expensive stocks and buy all the value stocks, it may be a good thing to do. But, you know, there are going to be some good opportunities when stocks come down big time and crash. And there are going to be some probably some unbelievably good values ahead. And one should, of course, never discount how far a stock can actually fall. Back in 2000, I remember Nortel peaking at $124. Okay, at the bottom of the bear market, the stock dropped to 66 cents. It was almost unbelievable. It then, by the way, rallied to $12, but then its balance sheet caught up with it and it went bust. But that's another story altogether. Now we're stopping looking at the values and we're looking at the quality of the balance sheet. Another story for another day. Breaking key support, whether it's market or a stock, allows the user to go short either the stock or the market. That's what I would call thriving, taking advantage of what's going on. We, as a general rule, do not recommend going short to our clients, but I happen to know that many of our clients use our service for precisely this purpose, or simply to exit from the market. That is simply surviving. Okay, in other words, we're not going to lose any money. SVA breakpoint levels for the overall market are very useful in anticipating rebounds in individual stocks, that is to say, thriving. But you got to pay close market attention. Now, here is the NASDAQ in the 2000 to 2002 bear market. And look what happened on the way down. Okay, yes, look at that. Okay, it went from a high of, 5,000 down to a low. I would guess that was pretty close to about 1,000, about an 80% decline. But look at what happened on the way down. There was some spectacular rallies. 41, 42%, 28%, 41%, okay, 51%. So lots of opportunities to make money. But what you've got to know is where those breakpoint values are. And that's what you can do by watching the NASDAQ 100 index itself and watching the breakpoints on the way down. Okay, now, sometimes something comes along which is so wonderful that you say, gosh, I wish this would happen all the time. And I'm going to show you a walking downstairs pattern. In other words, how to trade a bear market. And I'm going to show you the chart of Coca-Cola back in 1998 to its bottom of 2002-4. Now, first thing that we see is that look at the Coca-Cola was way up with HB5. That's 33 times book value. And look how far it was above its fair market value. Okay, just like we've seen Adobe, Starbucks, dozens and dozens and dozens of stocks so far. A long way to go. However, also look at what was happening to the balance sheet of the company and the fair market value of Coca-Cola. This company, in that whole bear market period, 98 through 2002, never missed an earnings beat. Never one. 15%, just as regular as clockwork. Well, what happened to the stock? Well, looking at those fundamentals, the stock, yes, it was overvalued, so of course it got its clock cleaned, but had a nice rally. Then, so that was down 2, up 1. And as soon as I saw that, I wonder if that's going to repeat. And sure enough, it did. Okay, and ever after that, till the bottom, we played Coca-Cola as a 2 down, 1 up decline and rally. Now, you look at that and say, well, yeah, Ross, are those things worth even bothering to trade? What are you talking here? Well, look at, okay, from here to here, from the bottom of a zone to the top of the zone is plus 28%. Okay, wouldn't you like to have a portfolio that compounded itself annually at 28%? Well, here is a stock which did that 1, 2, 3, 4, 5 times, I think, on the way down every time. And by the way, of course, the decline from if you get a 2 breakpoint decline down here, that's minus 44%. So these, they look small here simply because of the scale, but I'll tell you, these are big changes and can be very profitable changes. And if you get the hang of one of these stocks, and I'm kind of looking for one, I'm kind of hoping that I might have found one. I'll show you in a moment. Anyway, at the end, Coca-Cola finally got down to its fair market value. I don't think that it ever got down to any kind of a significant discount to the fair market value, because the stock just continued to nicely march on at an annualized 15% compound rate. It was that used to be, and probably still is, quite a company. Now, is there a possible walking downstairs pattern? And I think maybe it might be this one. Nothing is guaranteed, but let's go and take a look here. We've had this long sideways move here. I remember when we were talking about Fang Friday, I said that the HB2 price was a 10-year valuation low. Well, the stock price fell from the top of its HB3, didn't hold, fell, gave us a nice bounce, and now has fallen 2 breakpoints, given us a nice bounce. I'm wondering if we're going to see the same thing happen again. Now, Amazon has never been below its bubble price. So it's going to be in uncharted territory if it comes down there. But when I look at the fair market value, I would have to ask the musical question, where else is it going to go? Okay, I'm going to finish up with what I call my bear market, 7 bear market R's. First, realize that prices are going down for some time. Okay, in this market, we've only got started. Okay, it's been going down now for about 5 months, if I count the top of the market, back in the late 2001, but it certainly is not hurrying down to any kind. It's not plummeting the way it did in 2008, or even for that matter in 2020. So it's taking its time. Well, realize that prices, that means maybe going down for some time. It's maybe more like 2000, 2002, or 72.4 than 2008 or even 2020. Recognize that this is a trade, but don't buy the dip situation, okay? In other words, going down, we may be looking for opportunities to bounce, and we see that sometimes they can be spectacular. But you've got to remember, you've got to enter and you've got to exit. This is not a buy and hold for 5 years. That's not what this kind of market is. And that means you have to resist the temptation to jump back into the market when you see a 5 to 7% positive day in the market. The be realistic and understand that stocks need to fall to their clearing prices. And by their clearing prices, I mean they've got to fall to their fair market values and then a discount to it. Okay? That's when value reasserts itself again. And you can put those stocks away for the next few years. And probably with any luck, they have nowhere to go but steadily upwards. But that is not the case today. You've got to reverse your thinking of the past 13 years. The bear market long opportunities are scarce, and the short side bear opportunities will lead to long, slow, deliberate declines. In other words, you get into them and they sort of fall and they fall and they fall. They say, gosh, soon it's got to stop sooner or later. Well, no, it don't got to stop sooner or later. They can go. And then, of course, what they'll do, remember, we saw with Coca-Cola, they'll go down and then have a nice bounce. You say, oh, there you are. You see, thank goodness. Okay, back on side. And then they'll go down, 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 down. Oh, dear, I should have sold. Then they'll go up there. Oh, glad I didn't sell because it looks like it's going to recover, and so on and so on. So you've got to rethink and reverse your thinking on what the market's going to do. And you've got to revise your expectation, therefore, for the next period. And for those of you who have access to the SVA charts, remember to regularly review your SVA charts because they will give you the cues that you need to survive, thrive, trade, and exit these markets. Okay, thank you very much. Gilbert's going to say a couple of words, and then when he's finished, we'll have some time for Q&A.
Absolutely. Thank you, Ross. That was a tremendous presentation. I think that it's helped all the viewers that we have on the call here today. But before we move on to the Q&A, what I'd like to do is just show you quickly how you can sign up for SVA here. So what I'm going to do here is, I know that some of you on the call have already signed up, you've already registered, you have access to the SVA charts right here if you were following along. All you have to do is go to www.strategicanalysis.ca. This is our public website here. And what you'll see is at the top right there is a page called Pricing. If you click on Pricing at the top right, it will take you to the registration page where you can register right away and get access to our proprietary charts and our entire website that contains over 100 webinars that Ross and I have conducted over the past 2 years and many other perks. So what you want to do is you want to come down here and we have a special 3-month trial offer for those who are in this call, or if you are watching the recording regularly, it is $209 a month for Insight Edge, which is the basic level. You can also choose Decision Engine, which is the more advanced level. There are more advanced features, which Ross can go into at a later point, or you can explore on your own. However, we do have a 3-month trial, and we will honor this 3-month trial price for 3 months. So what you do, let's say that you want to sign up for Insight Edge. Click on Insight Edge right here. And the first thing that you want to do is going to take you to the screen, welcome screen. You click Next. Then these are the terms of service. I've read them several times, so I don't have to read them, but you want to make sure that you read them. Click to make sure that you understand the terms of service. And obviously your privacy is very important to us. You will give us some information, but this information stays completely private. We never disclose this information to anybody. So just make sure that you click that, accept that. And then what we can do is you can put your name in here, and let's just say I'm going to use a random name. This is Abdullah's name. Hopefully he doesn't mind us using his name in here. And we'll put in a password. Oh, of course his name already exists, because he is a client.
Yeah.
And then what happens here is you will be taken to the subscription plan page. And so what you will do is just put your credit card, your name here, and then your credit card number, CVC, and the expiration date, and you will get started right. You can get started right away. You get access to our website immediately, and so you can look through all the charts. There are around 3,000 North American charts that are available, and we're always updating the database, or as the case is, as companies are getting merged and acquired, we are removing those companies, as it were. Now, we can see here on Insight Edge that it does say that this is the trial period is only for 1 month. Please ignore this. We will honor this offer that we have on the public website. So the trial period, if for Insight Edge, is $109 a month for 3 months, and we will honor that for 3 months during the trial period. Or if you decide for the higher level decision engine, you can get 3 months for $249 to see if this is really something that you want to be interested in. You can take a look. Our service includes, well, just under 3,000 charts.
Can I take over here?
Please, yes.
Okay, good. Yes. Okay. I want to tell you what you get when you sign up. First of all, we have about 3,000 North American stocks and a smattering of foreign shares as well. A few Chinese stocks and so on. We will send you a copy. That's an electronic copy of my book, Inside the Market, which will deal in excruciating detail with all of the aspects of SVA. When you sign up, I like to take you individually through a personal webinar. Okay, it usually will last about an hour, sometimes an hour and a half, because I want to make sure that you fully understand and are comfortable with the SVA approach to stock market analysis. So I like to take you through it. And I also want to listen to you, because I want to make sure that our service is actually what you want, need, and expect. Okay, because sometimes people are, this is a do-it-yourself service, okay? This is not a hand-holding service where we go and pick portfolios and all the rest of the stuff. That's not what we do. This is a do-it-yourself service. However, you can have access to me or Gilbert anytime that you need, and there's a little feature on our charts that allows you to come or actually email us, and then we will get back to you and answer your questions. Now, finally, every week on Tuesday, we have a client webinar in which we discuss the issues of the day, any and all key developments that are occurring, any issues that our clients may have with individual stocks, and generally exchange useful information with our clients. And that exchange useful information with our clients, that is not a that's not a misprint here. We have a lot of give and take, a lot of information flowing back and forth with our clients, and our clients sometimes come up with very useful insights. So, as I say, our relationship with our clients runs two ways. Okay, I think in that case, Gilbert, if we have any questions, we can go to them.
Okay, absolutely. That's great. What I'm going to do here is we're going to end the recording right now, and then we'll get into just a handful of questions that we have. So thanks, everybody, for watching, and for everybody on the recording. Remember, you can take advantage of this offer right now and have access to our website and our charts.